Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Antmar Markets on Friday. It's the 4th of December. It's especially noteworthy today because we are looking at something we refer to as seasonality. And we will have another webinar in the upcoming 1-2 weeks. Probably makes sense shortly before Christmas, in fact. Topic is the Santa Claus rally, in fact. And when we talk about things like Santa Claus rally, we usually look at something we refer to as seasonalities or seasonal commodity trading patterns. Commodities in this case, not only related to. Oh, 1 second, please. Just have a look here. What do you have here? Okay, so. We're not just talking about things like wheat, for example, or sugar or cacao, cocoa, I'm sorry, but also things like gold, for example, but also interest rates and interest rate markets, for example. And we want to dig deeper into this topic. We want to shed a light on a, in fact, very fascinating topic, and one which is currently probably of highest interest when it comes especially to gold. Why this is the case, you will learn this in a few seconds. Or few minutes probably. And let's now first of all have a look at today's agenda to get a better overview of what we want to look at today. So first of all, we want to shed a light on the question, what is a seasonal pattern? Introduce this very fascinating topic to you. Then the next step, we will spot seasonality in gold. Have a look here at the seasonal chart and the performance in gold, especially into the end of the month of November, respectively over the course of the month December and January. So in fact, the current environment we find ourselves in. Then we want to answer the question on how to spot seasonality, in fact. And then the classic example, let's say, based on what you should expect to see when looking at a market like wheat, for example, classic commodity in this case. And then at the end of this webinar, we want to answer the question, how to trade seasonalities, in fact. Yeah, and before we start, first of all, probably for all those of you who have not yet listened to any of the webinars being presented here within this Trading Spotlight webinar series, my name is Jens. I'm within this financial industry now for something like over 10 years, probably close to 20. I started as an employee with a bank, in fact, a trainee back then. And during this time, I found out that I wanted to be, especially in the trading environment, that this is the place to be for me. And the only problem with that was that the retail business in which I found myself during my traineeship here didn't offer much, despite some kind of private banking, asset management service here for high net worth clients, but it wasn't really trading or related. And so I decided then to go up myself after, oh, no, not on myself, no, that's not right. I went on myself after that adventure I took then after I finished my traineeship. So first of all, I found out that I had to study mathematics when I want to get some momentum within the financial industry. That was shortly before, or no, several years, 2 years before the great financial crisis, in fact. So times have changed a little, especially from a regulatory perspective. But I decided, or I wanted to be in the investment banking trading industry here. And I found out that I had to study mathematics, respectively something with a quantitative approach, in fact. But that alone didn't cut it, especially after you earn some money as a trainee within the bank. And then so I was looking for a job, and hopefully for a job which was somehow related to my overall target to land a job in the trading industry. And my girlfriend back then, my ex-girlfriend now, she had, or her father had, a relationship to a guy who was working for a big stockbroker, and thus where that was my entry, in fact, in the trading world. So I started really at a trading desk as a professional, as a trading assistant here, learned to trade the markets from scratch, especially stocks, and took my career from there. But this is probably a little too much right here. I just I'm sorry, it's just like I got lost a little. Yeah, today the main focus is especially here on Antmar Markets and the broker behind this Trading Spotlight webinar series. And this is especially noteworthy due to the fact that Admiral Markets is a global financial service provider who's in the industry, in this industry, especially FX and CFD trading, now for nearly 20 years. So next year, I think there's the birthday, and it has the company, the broker, has 20 offices around the globe, and one in Berlin in Germany, the city I'm located in fact. And yeah, that's not the main reason why we work together, but it's probably something which is noteworthy, especially for those now listening here to the webinar, because having offices around the globe in over 20 countries around the globe is something which is of high interest for many people out there looking for a broker where they can to a representative can talk to a representative in their native language, in fact. So this is probably one of the lessons I learned when working in a bank as a trainee there in the retail industry, especially because people, when it comes to financial questions, just want to talk to someone who is speaking their native language. And that's something which is especially of high interest when we look at a global player like Admiral Markets, beside the very competitive offering. When it comes to in Germany, for example, we refer to Admiral as the DAX expert and the broker who is really known for the best offering, most competitive offering when it comes to DAX 30 CFD trading. Beside that, there's also a very competitive offering when it comes to Forex trading, a true multi-asset broker we can call Admiral, also offering physical stocks. There's this Admiral Invest offering, for example. So long thing short, check out the website admiralmarkets.com for further informations here. Yeah, feel free to reach out and talk to the guys in the support who are very, very helpful. And today, now we want to focus on our question here: what is a seasonal pattern? And so seasonal patterns, or seasonalities in general, are regular and predictable cyclical patterns that recur every calendar year. This is the most common explanation, in fact, for seasonalities. And in fact, every industry exhibits unique seasonal trends based on solid fundamental drivers. This is something which is of high interest when looking at seasonalities. In general, it makes sense, and we don't need to limit what I say now to seasonalities, but also to correlation. And then you probably have spotted that once one market rises, another is probably dropping, and vice versa. So that there's a negative correlation. Sometimes there's one market rising, another is rising. There's a positive correlation, and then there are tools. For example, on the website from Admiral Markets, you can find a so-called Supreme add-on. The Supreme add-on you can download and yeah, put into your MetaTrader as an extension, let's call it, for your overall trading experience, especially when it comes to a mini terminal. This Supreme add-on has such a correlation matrix included. And then so you can compare different markets to each other, and you can see if one performs in a certain way, moving up, for example, how is another market compared to this market then performing? And if there's a high positive correlation, you might say, well, there's obviously this connection between those two markets. Very great. So this is probably something I can profit on. The question is, and here we're only talking about correlations, does this make sense? So what you just spotted, it's great that you have such a detailed look on the markets, and that you really try to understand the markets, and also how one market and the developments there might affect another market. But at the end of the day, it's always the question: does this make sense, or it's probably just a pure coincidence what's happening there? The same is true for seasonalities. So the more data, or put it simply, the more data you have, and the more sense it makes, for example, that during, let's say, a period of hot weather, for example, or dry market conditions, for example, that then, for example, wheat prices rise, or the probably pattern you might spot that during the winter months, for example, oil prices might rise due to the fact that people need oil to heat their houses and their apartments up, for example. So if this makes sense from a fundamental perspective, this is then probably a fair way to start. I'm not saying it needs to be that obvious, in fact, because based on the obviousness, then in this case, most likely it could happen that the advantage which could be given here could be, what's the word for this? So annihilated. Yeah, probably that's the right word for this. So just or negated. That's not given anymore, but just it vanishes. The more market participants are aware of such a obvious pattern which might occur, the more or the greater the chances that just vanishes and that there's no real chance to capitalize on such an observation. And so when looking at this, it should make sense. Still, it's not limited to that, but mainly seasonality might occur in areas where you just don't expect them. So I, for example, was very surprised, especially for Forex markets. There's some really interesting developments here. They are more and more vanishing and are not given that active anymore. But sometimes, based on some simple explanations, for example, from a fundamental standpoint in this context, it might be tax reasons, for example, interest payments, or banks, I don't know, and ending their fiscal years, and all this might result in reoccurring patterns, in fact, seasonalities, which you can then profitably trade on. So it's not just limited to harvest periods here, which is obviously one of the probably best known seasonal drivers, and for simple reason, because it's obvious and everyone can feel that. The same is true when we look at the weather, for example, from our end. But there's also, given seasonalities in certain markets, you have to find out about, certainly, and run a data research in this case. You have to have some, potentially, it makes things easier if you're familiar, let's call it, with techniques from the data science universe, let's call it. And Python, for example, we had some webinars here in the Trading Spotlight webinar series, which shed a light on how to use Python to calculate risk, for example, valued risk, and some simulations we did together with that. So it can help. It's not necessary, but it can definitely help to run big data tests, in fact, and back tests in this case, and check out whether there's some seasonality happening. But it's, again, it can occur, for example, around timing of interest payments, for example, tax or balance sheet deadlines. Happening, for example, I knew about one seasonality which is happened for a quite long period in the Swedish krona, for example, happening due to a window which opened there into the yearly close, given a certain development around tax payments taking place, if I'm not mistaken. So I haven't prepared this right now, so I can't prepare or provide you now with the details. But there's sometimes very interesting developments beside the fact that they can be profitably traded on. But in addition to that, it's also very interesting to see that it's not just a pure number you see on your screen and the market behaving in one or the other direction, and there's sometimes no real sense to it, and it's just making an erratic a move on the up or on the downside, but there's real monetary reasons. So there's really money flowing in or out of a currency, out of a commodity, out of a financial index or whatever, happening there for reasons. Then, since it happens over and over again over here, for example, every quarter or something, there's seasonality attached to that. I already referred to earnings reports. Certainly, there's also some seasonal aspects which could play a role here. Also, the weather, as I already mentioned, investor sentiment at certain times of the year, for example. But there's also traditional patterns happening. For example, as I already mentioned at the beginning, the classic year-end rally in the stock market, the so-called Santa Claus rally. By the way, we will again spot especially this seasonal pattern here. Oh, it's not spotting it, but we will dig deeper into this seasonal pattern in a webinar in 1 week from now. So next week on the 11th, I just checked my calendar. Next week we will have a look here at the Santa Claus rally, building on this webinar right now, so that you have already a good starting point. And so these seasonal patterns, they occur. And now it becomes the question, okay, first of all, could you give an example of such a seasonal pattern? Yeah, I can, and I will, because now we will look at the seasonality in gold and why especially it is interesting right now. In addition to that, I will then give you an idea on how to build your own or what is needed. We won't build it, but what is needed here to create your own seasonal chart, in fact, and what you need to do for that. But first of all, here, let's have a look at the seasonality in gold right now. By the way, let me just check. Do we have questions here? No. Okay, so first of all, let's have a look here at the seasonality in gold. This is a chart which goes back for nearly the last 30 years. It hasn't changed. In fact, there is some positiveness to what we now deliver over the last 4 years, but this chart alone goes back the last 30 years. And it spots the performance from gold and gold prices in this case here during certain periods of the year, or respectively on a monthly basis. How did gold perform in a certain period of time? So where are we? Well, we are here, as you can see. So we are in December, and this is probably of interest here because you might say, "Wow, look at this." Then probably, since we are at the beginning of the month, probably we're about to see another leg lower. Just to remember what I told you last week, probably you checked out the last webinar. That was a Black Friday webinar. So that was the day following Thanksgiving. And I said the push here on the downside. I'm currently watching 750 to 760, 1,750 to 1,760, since I'm not really sure whether this is a sustainable move. And this level was especially interesting from a technical perspective, but also I knew that we are now entering an overall very seasonal, bullish seasonal window in gold, in fact, especially in the month of January here. So have a look at January, especially. You can see, by the way, a normalized chart. What this is, I will explain in a few minutes. But we start here from 100, and you can see that over the course of January, the average performance over the last 30 years in gold here was over 1%, so positive on the upside. While the overall performance in gold in December wasn't that positive, in fact, but we already started with some positive developments here at the end of October, especially, where there was at least signs of a bottom. Then the thin market environment and overall probably some developments around the COMEX and the problems which could arise due to physical delivery here and all this with options expiring, future price or futures expiring, that could all lead to, in fact, some, let's call it some kind of manipulation, which could then result in elevated volatility, and here overall resulting in a different development, which we would expect. But overall, we can say, especially check just the last 5, 6, 7 years, how the performance, especially from mid-December, then into the new year, mid-January to end of January, how gold performed. You will find every year a bullish tendency, in fact, with similar developments taking place back over the last 4 or 5 years, similar to the events which took place right now, making it even more attractive, especially with the push lower and triggering potentially that region for long engagements, which I mentioned already last week in the webinar, 750, 760, which we then spiked to, I think, into the start of the week on Monday, if I'm not mistaken. So that was similar or close to the bottom. I think the low was 764. And from a risk reward perspective, given this seasonality, in fact, it's very interesting right now here to look at gold, also the fundamental developments. Potential fundamental drivers could be a fiscal stimulus, which Democrats and Republicans now agree on, for example. There could also be a very dovish approach or rhetoric, which is used then from the Fed at her last meeting this year, which will take place, if I'm not mistaken, so for 16th. Yeah, it's the 16th of December. So there's several reasons, potential drivers, which could then result in this ongoing bullish seasonality, or which could trigger further bullishness, and add to this seasonal pattern which already developed over the last years. For whatever reason there might be. So right now the reason might be that there is this big corona relief package, that there is a dovish rhetoric from the Fed being used, that could be the driver right now. But also over the last years, there were several events where gold performed extraordinarily well over this period of the year. In fact, a classic seasonal pattern which appeared there. So that's just where to spot seasonality right now. By the way, just for example, oh no, just let's go back here. Um, Also very interesting, especially now this year. Certainly, we need to see whether the market stays as calm as it's currently presenting itself. Especially when you're, for example, looking at the DAX right now, you might have spotted that there's very low volatility right now, so very choppy price action. If we look at the Santa Claus rally here, what we can also spot, I haven't prepared it right now, but just for those of you now, especially focused on Forex markets, into such a potential risk on market environment in which yeah, especially high yield currencies, but this is very difficult in the right current environment with the Australian dollar and New Zealand dollar. But there has been a time, let's put it that way, where there was some kind of a yield differential. So central banks around the globe just yeah, killed this potential yield differential, at least among the, let's say, G7, G8 FX currency universe. But you can also spot a classic bullish seasonality in currencies, so-called high yield currencies or risk on currencies, like for example the New Zealand dollar or Australian dollar over the yearly yearly close, respectively, the New Year's Eve in this case. Starting sometimes from the 20th, around 20th of December, going then into the start of the new year up to the 5th, 6th of January, where, for example, the New Zealand dollar performed quite well over the course of the last 20, 25 years against pound sterling, for example. Or also the Australian dollar performed quite well against pound sterling. Not sure whether I would right now in this market environment, especially a bet against pound sterling. So to me, it makes the impression as if there is some further upside. But just to give you an idea on how this might also affect Santa Claus rally in this case, how this might, for example, affect Forex markets, if you haven't yet thought about this. But there's also seasonality happening from time to time in Forex markets. I already mentioned the Swedish krona, but also into the yearly close, low volatility market environment, Santa Claus rally, risk on tendency. There's also a tendency that currencies like New Zealand dollar or the Australian dollar, for example, perform quite solid, let's say, at least. And so now we want to answer the question on how to spot seasonality. So, and what do we need to spot seasonality? In fact, it's just two things. So it's historical data, hopefully lots of it. And then we need some knowledge about mathematics, respectively statistics. And so what we do is, first, we need to take all years we use for calculation and overlay them on a chart. I will show you this in a next slide. I found a website, but I don't share the link here because that makes no sense. It's a German website, in fact. I also have the source there, so you can check it out yourself, but I won't share it because it's a German website. So, but you will see how this looks in the real world because it's provided there for free, in fact. It's an overlay of all charts. And what you do in the next step is, in fact, 1 second, please. Okay, no worries. Have a nice weekend. Ria just let me know that she has to leave. No worries. So have a nice day. Have a nice weekend. Hope to see you next week on the next Trading Spotlight webinar, Santa Claus Rally. So, and then what we do in the next step is we have to consider extremes and include a so-called normalization here. So normalization is, well, we can say it's a recalculation of prices of each year to percentual 0 to a 100% scale. So you have seen that in the slide before here. So you take the low as 0% in this case and the high as 1% and adjust all data accordingly. So this is where your mathematical statistical skills come into play. And this explains why here we have 100, 101, 102 in this case, in fact. So this is due to this normalization procedure we're going through here. And so let me just here go back to this point. And then what we do in the last step, in the final step, we normalize price for all years and calculate the average. So for example, you look at how was the performance over the last, let's say, 20 years in November for gold in this case, And you normalize then the chart in this case. And what you do is you calculate the average performance in percentage then for each November, and get a data point for the month of November. Respectively, if you have every day of the month of November, you get the possibility to connect all dots here for all trading occurrences over the course of, let's say, the last 20 years, for example. But this sounds very theoretical. So what I now did here is I prepared something on the seasonality in wheat, and want to give you here an idea on how this overlay might look like. So this is from suricate-trading.de. It's a German website from 1/2 guys. I'm not really sure how much manpower they have within their team, and they're also attending, if I'm not mistaken, quite have already and still participate in this Trading World Championship, I think we can call this. This is the event where Larry Williams performed extraordinarily well with sometimes I have to say ridiculous percentages or performances. By the way, Larry Williams is one of the biggest supporters, for example, for the Commitment of Traders report, for example, also something probably noteworthy. So in terms of seasonality in this case, what I know is that Commitment of Traders report, but also seasonality here, plays a quite important role within their trading. And that's why they offer this data here. In fact, we want to only use this here for illustration purposes, so they get a better idea on how to work and what I mean in case of the point when I say we need to overlay them on a chart, in fact. And yeah, what they do is they have now, I think this is for the last 20 years, 25 years, I'm not sure. They take all developments here in the prices of wheat, they overlay it, and then you see here this bold black line. This is the average. So they calculate the average of every chart, respectively, of every curve they have here within this graphic. And what they then do, you can see there have been days when, for example, there was an extraordinary bullish performance, not close, but even though quite extreme when looking here at the normal developments. By the way, 1 second, please. I'm sorry. 1 second. Okay. So, and what they then did is, in fact, they calculated an average. And this is what you can see here. So even though it looks different, it's still the same, the same curve here. The black curve is the same, only that they change here the y-axis in this case. And then you get the seasonality in wheat. And surprise, surprise, you see bottoming out wheat prices around the month of July and taking a quite steep rally, in fact, over the course of the last 6 months here of the year. And so this is how you can then, get an idea on how to visualize this seasonality. So you have all the data, the historical data. You then you overlay this data on a chart. In the next step, you consider extremes and you include normalization in this case. So you recalculate prices here each year to a percentual 0 to 100% scale. And in the final step, you normalize price for all years and calculate the average. And this is then what you get, your seasonal chart, in fact. And this is how you can create your own seasonal charts, in fact, for every asset you want to look at here. So for example, you might now say, okay, wheat is very interesting. We have seen gold now. Can we do this not just on Forex pairs? As I already mentioned, for example, GBP NZD or GBP Australian dollar, or when it comes to Santa Claus, we can certainly also calculate such a chart here for the S&P, for example, over the last whatever years, let's say 25, 30 years, and then have a look here whether there is really such a development as the Santa Claus rally into the yearly close in the second half of December, and then into the start of the year of January, for example. But you might also be interested in seasonal windows, which might open in shares, for example, stocks. So probably there's some developments given whatever there might be tax, balance sheet, periods which end, deadlines, whatever, which could result in reoccurring tradable, profitably tradable seasonal windows in stocks, which could happen then. So the process is, again, as I already said, you need the data. If you have the data, you need some knowledge about statistics and mathematics, and take it from there and can create your own seasonality in whatever asset class you like. So, by the way, here's the source. So if you want to check this out, then suricata-trading.de and /seasonal-charts. There you can get lots of data here around this. This is seasonality in wheat. You can also create this for gold, for silver, whatever you like, in fact. And so now the question arises, nevertheless, very interesting, as I already said, most likely something very fascinating for some of you who might say, well, this sounds really great, but how can I use this in my trading? Can I trade based on seasonalities, respectively? How can I use this in my trading? And so in my case, especially when it comes to gold right now, but also in other cases, seasonalities are used, in my case, as an additional component, in fact, or a filter in my discretionary trading, respectively, my automated trading. So to put this in a clean context and simply speaking here, you spot, for example, a head shoulder formation in gold. You plan, or it is within your trading style, your trading approach, that you plan to trade head shoulder formations, for example. You spot one in gold, you know how to trade it profitably, so this is no question. And now, obviously, head shoulder, it's a trend reversal pattern which occurs in the chart, which means that you plan to trade gold from short side, technical speaking, and purely taking the technical side into account here. But now, just assume that this head shoulder pattern formation is spotted right now. So at the beginning of December, do you still plan to short gold here, since we are about to enter a bullish seasonal window in gold? So there's now several approaches to that. One is I completely ignore seasonality. One thing I'm not really comfortable or feeling comfortable about, in fact. Another is we just skip the trade. We don't take the short position since we don't have or don't want to trade against the seasonality. We could also, this is probably the middle of the road, let's say, in this approach. We could say, well, we don't want to trade against the seasonality on the one hand, but we have a clear technical setup which favors our overall trading, which means probably we should take the trade, but with a reduced position size. This is probably something we should also look for. So this is one way how to trade with seasonalities and the knowledge around this. So it's not just that you can take trades based on seasonality, which is, by the way, the next point here. So how to trade seasonalities. For example, we trade solely on them, especially if a pattern has a high win rate. So in fact, I'm not kidding here when I say a win rate of 80% plus is quite common for some seasonal windows which open. So if I'm not mistaken, and if I remember the numbers right, unfortunately, I'm not that well prepared, which is a shame. But the seasonal window I just mentioned in gold has a win rate between 75 to 80%, in fact, over the course of the last 20, 25 years, if I'm not mistaken. So it's a quite high win rate. Just imagine that. So given such a high win rate, it's, in fact, it can be quite interesting to trade solely on these seasonal windows then in this case. And so this is also an approach you could easily use here. And finally, we can use seasonality as a timing tool to optimize, for example, pro-cyclical entries into a position once the seasonal window opens. So for example, look at gold right now. So if you wanted to know when is likely the bottom in, let's say, unfortunately, let me just see. I just I just realized that it makes no sense to just talk about gold and talk and talk. But we could easily also open here a chart. The reason I have the MetaTrader not right now open is because of the potential resource issue, let's say, so that my laptop could have some trouble here going with the presentation here, the usage of the webinar software. Then we open also the MetaTrader. Sometimes this is an issue. I just hope that it's not an issue. And then what we can do is we can use here the chart. One second. We can use the chart for gold in regards to our optimization of our entry in the current environment. Some of you might have wondered, especially last week. I mean, it's just 7 days ago. You might have wondered, when is likely the bottom in gold? We can't even say whether it's in right now. I don't know, to be honest. I'd really love to know that, but just imagine you have seen the break lower, which occurred already last week. That's not that long ago. It was on the 23rd of November. Yeah, we broke below a very important support level at 1,850 USD. And some of you might have wondered, has something dramatically changed? So is the overall outlook now darkened somehow? Does it make sense to trade gold, or probably I should step back here? I'm still very comfortable having a gold position. That's something I have to say. I think nothing has changed, and I think my overall bullishness on gold is still easily understandable for everyone out there. I could easily explain why I favor long engagements in gold, and why I still favor it above really, yeah, nearly every other approach right now. But the thing is, still you start to question your overall approach here, and also the correctness of your analysis. I think easily, again, we could now start, and I could give you a 15, 20, 30-minute roundup on why I think gold is headed higher. Still, if you see last week or 2 weeks ago, around this break lower below 1,850 USD, you start to wonder whether probably this time is different. And so now, nevertheless, the question is, when I plan to trade the long side again after this parabolic rise and to optimize my overall entry in positions, how can I use seasonality here? And then I know that the end of November, the month of December and January is probably or is known to be seasonal bullish in gold, which means that the push lower here into the end of the month of November, which took place on Monday, so 4 or 5 days ago, and the technical relevance of this region, which I already made a topic last week on Friday here within this webinar. I said 750 to 760. We can now use these two potential criteria to formulate a long setup against 750, 760, and then take it from there. The fundamental picture hasn't changed at all, so it's still very favorable for gold. And if we combine technical analysis with the overall bullish seasonality we're currently entering, the very favorable environment from a fundamental perspective we find ourselves in, well, what you then have is a classic long against this region here on the downside, and then taking it from there. So far, it works pretty well, let's say. So we're about to at least retest, and this is just in one run up, let's say, the breakout region around 850 here. If we now close above that level, well, there's no real reason to not believe that we also, or given the hit rate, given the numbers, the statistics, that gold is likely to continue higher within that at least the next weeks. So even here, after that run, even here, it has been more attractive certainly to buy around 750, 760, that region from a risk reward perspective. But even here, I think the risk reward is still favorable for the long side. If I take this research now, and I just guided you through my thoughts in a very rough way, but I think in an understandable way, if I take this, well, then you can say, okay, based on that, I can use the current developments, the current environment in gold as a potential trigger, seasonality bullish, seasonal window in gold, which is opening as a criteria here for justifying a long trade in this case, and then formulate a setup with my overall target on the upside, certainly, which has to have a attractive risk reward. So also clearly defining my stop here, most likely to be set below the lows, which we set on last Monday, 764 or something. Yeah, and then taking it from there. So this is how you could trade seasonal windows, seasonalities, given the current environment in gold, in fact. And let's sum this up. Let me just check out here. Okay, let me just see. 1 second. Okay, so there's no real question to the content I've seen so far. It was just like some thoughts. I hope I answered these thoughts here on gold, how to trade gold in the current environment. So the thing is, by the way, this is something we can now see at several accounts. For example, social media, for example. Some people say after this run up we've seen now nearly 100 USD, not really, but close to over 80 USD. It's right now. Let's see where we close the week. That people now say, hey, what about waiting for another pullback in gold and then trying to capture the next leg higher? I think this will be very, very, very difficult because gold is known to be a very yield sensitive and also trend stable asset, which means like if there's a trend, it just trends and there's no real significant pullback or something. So that's one of the reasons why this push to 750, 760 was so interesting to see, in fact. And also the big switch in the overall sentiment with many people now becoming overly bearish for gold, in fact. So let's put it simply. In July, August, at the beginning of August, when gold pushed to and above 2000 USD to new all-time highs, you had the feeling everyone was bullish on gold or precious metals in general. So look at silver, for example. Everyone was bullish. And there was just such a heated environment, upheated environment. And there was such a strong bullish bias among retail traders, especially, that this could easily be used as a contrarian indicator. Now, the tide has completely turned and we are turning into a very bearish sentiment environment. And now I have somehow the feeling that many just see the recent run up again and are probably like, okay, probably we are still bullish on gold, and now I will buy the next pullback. I'm not really sure whether this pullback will really happen, or if it's not just more likely that gold has now probably seen its potential bottom and is now just not turning around anymore, just running higher. Just one thought on this. So I have a very long-term view here on gold, so that does not really affect my trading. But I'd probably not expect a sharp push lower, another big leg down or retracement, we call this, but it's more likely that there will probably be more kind of a consolidation area if it happens. So that we have a strong run up now, and then that we are working on something like a flag, for example, a bull flag or a consolidation pattern, wedge pattern, whatever, and that we take it from there then. But there's no this sharp retracement now happening anymore. But just my thoughts on how I currently expect gold to perform. Let's look at the summary. So seasonalities are regular and predictable cyclical patterns that recur every calendar year. And every industry exhibits unique seasonal trends based on solid fundamental drivers. And the best known seasonal drivers include harvest periods, the timing, for example, of interest payments, tax or balance sheet deadlines, earnings reports, the weather, investor sentiment at certain times of the year, as well as traditional patterns, for example, the year-end rally, the stock market Santa Claus rally, which we want to look at here next week in more detail. And to spot seasonality, all we need is, in fact, historical data and some knowledge about mathematics, statistics, normalize the data, and then taking it from there. And you can create all seasonal charts which you want. And that's it from my end. So don't forget to join us next time. Monday, Paul will be here again. We'll look at stay-at-home stocks. Yeah, sorry, stay-at-home stocks. And work from home stocks. One software of a company is Zoom, for example, which the software we currently use. And what Paul will do is he will answer you here some questions around these classic stay-at-home stocks and work from home stocks, like how certain stocks fared during this year of a lockdown. Prepared some charts on that. I've seen them, really fascinating topics. So he will also answer the question. He himself, but also you are invited to ask your questions or give your comments on that, on which stocks have surprised us and why, and what ones will still hold their interest in 2021. Monday, 7th of December, 2020, 2 p.m. London. If you're here in the webinar, in the real webinar, so in the live event where you can ask your questions, then just check out your inbox for the webinar link. It's directly sent to your inbox. Just click on that and you will guide it to the webinar. If you watch this on YouTube, if you just enjoyed what you saw, please leave a thumb up here, leave a comment here, ask your questions, give us feedback on what topics you'd like to be covered in the future. Really like to hear from you here. If you want to now register for the real webinar, the live event every Monday, Wednesday, and Friday, check out admiralmarkets.com. There, go over to the Educations tab, Webinars, and there you can register for free for the Trading Spotlight webinar series. And this is the website to go over the weekend. Check out the website, admiralmarkets.com, for further information. And here are the contact details. If you have any questions on the not just content we provided here, but also on the products being offered from Admiral, then have a look here and contact Admiral directly. Regulated broker, fully regulated. That's one of the main reason why we have to show the risk disclaimer here at the end. That's it from my end. So all the best. Happy trading. Watch your stops. Talk to you again next week on Friday. Santa Claus rally will be our topic. I look forward to it. See you and bye-bye.